known in its industry as a prominent maker of industrial sewing machines. During the past decade it adopted a policy of diversification in what seems a rather outlandish form. For on the one hand it has an extraordinarily large number of subsidiary companies, at least 24, making an astonishing variety of products, but on the other hand the entire conglomeration adds up to mighty small potatoes by usual Wall Street standards. The earnings developments in Whiting are rather characteristic of our business concerns. The figures show steady and rather spectacular growth from 41 cents a share in 1960 to $3.63 in 1968. But they carried no assurance that such growth must continue indefinitely. The subsequent decline to only $1.77 for the 12 months ended January 1971 may have reflected nothing more than the slowing down of the general economy. But the stock price reacted in severe fashion, falling about 60% from its 1968 high, 431 halves, to the close of 1969. Our analysis would indicate that the shares represented a sound and attractive secondary issue investment, suitable for the enterprising investor, as part of a group of such commitments. Sequel. Wilcox and Gibbs showed a small operating loss for 1970. Its price declined drastically to a low of 41 halves, recovering in typical fashion to 91 halves in February 1971. It would be hard to justify that price statistically. Whiting had a relatively small decline, to 163/4 in 1970. At that price it was selling at just about the current assets alone available for the shares. Its earnings held at $1.85 per share to July 1971. In early 1971 the price advanced to 241 halves, which seemed reasonable enough but no longer a bargain by our standards. General observations. The issues used in these comparisons were selected with some malice aforethought, and thus they cannot be said to present a random cross-section of the common stock list. Also they are limited to the industrial section, and the important areas of public utilities. 470. Transportation companies and financial enterprises do not appear. But they vary sufficiently in size, lines of business, and qualitative and quantitative aspects to convey a fair idea of the choices confronting an investor in common stocks. The relationship between price and indicated value has also differed greatly from one case to another. For the most part the companies with better growth records and higher profitability have sold at higher multipliers of current earnings, which is logical enough in general. Whether the specific differentials in price-earnings ratios are justified by the facts, or will be vindicated by future developments, cannot be answered with confidence. On the other hand, we do have quite a few instances here in which a worthwhile judgment can be reached. These include virtually all the cases where there has been great market activity in companies of questionable underlying soundness. Such stocks not only were speculative, which means inherently risky, but a good deal of the time they were and are obviously overvalued. Other issues appeared to be worth more than their price, being affected by the opposite sort of market attitude, which we might call under speculation, or by undue pessimism because of a shrinkage in earnings. In Table 89 we provide some data on the price fluctuations of the issues covered in this chapter. Most of them had large declines between 1961 and 1962, as well as from 1969 to 1970. Clearly the investor must be prepared for this type of adverse market movement in future stock markets. In Table 1810 we show year-to-year fluctuations of McGraw-Hill common stock for the period 1958 to 1970. It will be noted that in each of the last 13 years the price either advanced or declined over a range of at least 3 to 2 from one year to the next. In the case of National General, fluctuations of at least this amplitude, both upward and downward, were shown in each 2-year period. In studying the stock list for the material in this chapter, We were impressed once again by the wide difference between the usual objectives of security analysis and those we deem dependable and rewarding. Most security analysts try to select the SUs that will give the best account of themselves in the future, in terms chiefly of market action but considering also the development of earnings. We are frankly skeptical as to whether this can be done with satisfactory results. Our preference for the analyst's work would be rather that he should seek the exceptional or minority cases in which he can form a reasonably confident judgment that the price is well below value. He should be able to do this work with sufficient expertness to produce satisfactory average results over the years. Chapter 19. Shareholders and Managements. Dividend Policy. Ever since 1934 we have argued in our writings for a more intelligent and energetic attitude by shareholders toward their managements. We have asked them to take a generous attitude toward those who are demonstrably doing a good job. We have asked them also to demand clear and satisfying explanations when the results appear to be worse than they should be, and to support movements to improve or remove clearly unproductive managements. Shareholders are justified in raising questions as to the competence of the management when the results, 1. Are unsatisfactory in themselves, 2. Are poorer than those obtained by other companies that appear similarly situated, and 3. Have resulted in an unsatisfactory market price of long duration. In the last 36 years practically nothing has actually been accomplished through intelligent action by the great body of shareholders. A sensible crusader, if there are any such, would take this as a sign that he has been wasting his time, and that he had better give up the fight. As it happens, our cause has not been lost. It has been rescued by an extraneous development, known as takeovers, or takeover bids. We said in Chapter 8 that poor managements produce poor market prices. The low market prices, in turn, attract the attention of companies interested in diversifying their operations, and these are now legion. Innumerable such acquisitions have been accomplished by agreement with the existing managements, or else by accumulation of shares in the market and by offers made over the head of those in control. The price bid has usually been within the range of the value of the enterprise under reasonably competent management. Hence, in many cases, the inert public shareholder has been bailed out by the actions of outsiders who at times may be enterprising individuals or groups acting on their own. It can be stated as a rule with very few exceptions that poor managements are not changed by action of the public stockholders, but only by the assertion of control by an individual or compact group. This is happening often enough these days to put the management, including the board of directors, of a typical publicly controlled company on notice that if its operating results and the resulting market price are highly unsatisfactory, it may become the target of a successful takeover move. As a consequence, boards of directors have probably become more alive than previously to their fundamental duty to see that their company has a satisfactory top management. Many more changes of presidents have been seen in recent years than formerly. Not all companies in the unsatisfactory class have benefited from such developments. Also, the change has often occurred after a long period of bad results without remedial action, and has depended on enough disappointed shareholders selling out at low prices to permit the energetic outsiders to acquire a controlling position in the shares. But the idea that public shareholders could really help themselves by supporting moves for improving management and management policies has proved too quixotic to warrant further space in this book. Those individual shareholders who have enough gumption to make their presence felt at annual meetings, generally a completely futile performance, will not need our counsel on what points to raise with the managements. For others the advice would probably be wasted. Nevertheless, let us close this section with the plea that shareholders consider with an open mind and with careful attention any proxy material sent them by fellow shareholders who want to remedy an obviously unsatisfactory management situation in the company. Shareholders and dividend policy. In the past, the dividend policy was a fairly frequent subject of argument between public or minority shareholders and managements. In general, these shareholders wanted more liberal dividends, while the managements preferred to keep the earnings in the business to strengthen the company. They asked the shareholders to sacrifice their present interests for the good of the enterprise and for their own future long-term benefit. But in recent years, the attitude of investors toward dividends has been undergoing a gradual but significant change. The basic argument now for paying small rather than liberal dividends is not that the company needs the money, but rather that it can use it to the shareholders' direct and immediate advantage by retaining the funds for profitable expansion. Years ago, it was typically the weak company that was more or less forced to hold on to its profits, instead of paying out the usual 60% to 75% of them in dividends. The effect was almost always adverse to the market price of the shares. Nowadays, it is quite likely to be a strong and growing enterprise that deliberately keeps down its dividend payments, with the approval of investors and speculators alike. There was always a strong theoretical case for reinvesting, Professor. It's in the business where such retention could be counted on to produce a goodly increase in earnings. But there were several strong counter-arguments, such as, the profits belong to the shareholders, and they are entitled to have them paid out within the limits of prudent management. Many of the shareholders need their dividend income to live on. The earnings they receive in dividends are real money, while those retained in the company may or may not show up later as tangible values for the shareholders. These counter-arguments were so compelling, in fact, that the stock market showed a persistent bias in favor of the liberal dividend payers as against the companies that paid no dividends or relatively small ones. 1. In the last 20 years, the profitable reinvestment theory has been gaining ground. The better the past record of growth, the readier investors and speculators have become to accept a low payout policy. So much is this true that in many cases of growth favorites the dividend rate, or even the absence of any dividend, has seemed to have virtually no effect on the market price. A striking example of this development is found in the history of Texas Instruments, Incorporated. The price of its common stock rose from $5 in 1953 to $256 in 1960, while earnings were advancing from 43 cents to $3.91 per share, and while no dividend of any kind was paid. In 1962, cash dividends were initiated, but by that year the earnings had fallen to $2.14 and the price had shown a spectacular drop to a low of 49. Another extreme illustration is provided by Superior Oil. In 1948, the company reported earnings of $35.26 per share, paid $3 in dividends, and sold as high as $235. In 1953, the dividend was reduced to $1, but the high price was $660. In 1957, it paid no dividend at all, and sold at $2,000. This unusual issue later declined to $795 in 1962, when it earned $49.50 and paid $7.50. Investment sentiment is far from crystallized in this matter of dividend policy of growth companies. The conflicting views are well illustrated by the cases of two of our very largest corporations, American Telephone and Telegraph and International Business Machines. American Telephone and Telephone came to be regarded as an issue with good growth possibilities, as shown by the fact that in 1961 it sold at 25 times that year's earnings. Nevertheless, the company's cash dividend policy has remained an investment and speculative consideration of first importance, its quotation making an active response to even rumors of an impending increase in the dividend rate. On the other hand, comparatively little attention appears to have been paid to the cash dividend on IBM, which in 1960 yielded only 0.5% at the high price of the year and 1.5% at the close of 1970. But in both cases, stock splits have operated as a potent stock market influence. The market's appraisal of cash dividend policy appears to be developing in the following direction, where prime emphasis is not placed on growth. The stock is rated as an income issue, and the dividend rate retains its long-held importance as the prime determinant of market price. At the other extreme, stocks clearly recognized to be in the rapid growth category are valued primarily in terms of the expected growth rate over, say, the next decade, and the cash dividend rate is more or less left out of the reckoning. While the above statement may properly describe present tendencies, it is by no means a clear-cut guide to the situation in all common stocks, and perhaps not in the majority of them. For one thing, many companies occupy an intermediate position between growth and non-growth enterprises. It is hard to say how much importance should be ascribed to the growth factor in such cases, and the market's view thereof may change radically from year to year. Secondly, there seems to be something paradoxical about requiring the companies showing slower growth to be more liberal with their cash dividends. For these are generally the less prosperous concerns, and in the past the more prosperous the company the greater was the expectation of both liberal and increasing payments. It is our belief that shareholders should demand of their managements either a normal payout of earnings, on the order, say, of 2/3, or else a clear-cut demonstration that the reinvested profits have produced a satisfactory increase in per-share earnings. Such a demonstration could ordinarily be made in the case of a recognized growth company, but in many other cases a low payout is clearly the cause of an average market price that is below fair value, and here the shareholders have every right to inquire and probably to complain. A niggardly policy has often been imposed on a company because its financial position is relatively weak, and it has needed all or most of its earnings, plus depreciation charges, to pay debts and bolster its working capital position. When this is so, there is not much the shareholders can say about it, except perhaps to criticize the management for permitting the company to fall into such an unsatisfactory financial position. However, dividends are sometimes held down by relatively unprosperous companies for the declared purpose of expanding the business. We feel that such a policy is illogical on its face, and should require both a complete explanation and a convincing defense before the shareholders should accept it. In terms of the past record, there is no reason a priori to believe that the owners will benefit from expansion moves undertaken with their money by a business showing mediocre results and continuing its old management. Stock dividends and stock splits. It is important that investors understand the essential difference between a stock dividend, properly so called, and a stock split. The latter represents a restatement of the common stock structure, in a typical case by issuing 2 or 3 shares for one. The new shares are not related to specific earnings reinvested in a specific past period. Its purpose is to establish a lower market price for the single shares, presumably because such lower price range would be more acceptable to old and new shareholders. A stock split may be carried out by what technically may be called a stock dividend, which involves a transfer of sums from earned surplus to capital account, or else by a change in par value, which does not affect the surplus account. What we should call a proper stock dividend is one that is paid to shareholders to give them a tangible evidence or representation of specific earnings which have been reinvested in the business for their account over some relatively short period in the recent past, say, not more than the 2 preceding years. It is now approved practice to value such a stock dividend at the approximate value at the time of declaration, and to transfer an amount equal to such value from earned surplus to capital accounts. Thus the amount of a typical stock dividend is relatively small, in most cases not more than 5%. In essence, a stock dividend of this sort has the same overall effect as the payment of an equivalent amount of cash out of earnings when accompanied by the sale of additional shares of like total value to the shareholders. However, a straight stock dividend has an important tax advantage over the otherwise equivalent combination of cash dividends with stock subscription rights, which is the almost standard practice for public utility companies. The New York Stock Exchange has set the figure of 25% as a practical dividing line between stock splits and stock dividends. Those of 25% or more need not be accompanied by the transfer of their market value from earned surplus to capital, and so forth. Some companies, especially banks, still follow the old practice of declaring any kind of stock dividend they please, for example, one of 10%, not related to recent earnings, and these instances maintain an undesirable confusion in the financial world. We have long been a strong advocate of a systematic and clearly enunciated policy with respect to the payment of cash and stock dividends. Under such a policy, stock dividends are paid periodically to capitalize all or a stated portion of the earnings reinvested in the business. Such a policy, covering 100% of the reinvested earnings, has been followed by Purex, government employees insurance, and perhaps a few others. Stock dividends of all types seem to be disapproved of by most academic writers on the subject. They insist that they are nothing but pieces of paper, that they give the shareholders nothing they did not have before, and that they entail needless expense and inconvenience. On our side, we consider this a completely doctrinaire view, which fails to take into account the practical and psychological realities of investment. True, a periodic stock dividend, say of 5%, changes only the form of the owner's investment. He has 105 shares in place of 100, but without the stock dividend the original 100 shares would have represented the same ownership interest now embodied in his 105 shares. Nonetheless, the change of form is actually one of real importance and value to him. If he wishes to cash in his share of the reinvested profits, he can do so by selling the new certificate sent him, instead of having to break up his original certificate. He can count on receiving the same cash dividend rate on 105 shares as formerly on his 100 shares. A 5% rise in the cash dividend rate without the stock dividend would not be nearly as probable. The advantages of a periodic stock dividend policy are most evident when it is compared with the usual practice of the public utility companies of paying liberal cash dividends and then taking back a good part of this money from the shareholders by selling them additional stock, through subscription rights. As we mentioned above, the shareholders would find themselves in exactly the same position if they received stock dividends in lieu of the popular combination of cash dividends followed by stock subscriptions, except that they would save the income tax otherwise paid on the cash dividends. Those who need or wish the maximum annual cash income, with no additional stock, can get this result by selling their stock dividends, in the same way as they sell their subscription rights under present practice. The aggregate amount of income tax that could be saved by substituting stock dividends for the present stock dividends plus subscription rights combination is enormous. We urge that this change be made by the public utilities, despite its adverse effect on the U.S. Treasury, because we are convinced that it is completely inequitable to impose a second, personal, income tax on earnings which are not really received by the shareholders, since the companies take the same money back through sales of stock. Efficient corporations continuously modernize their facilities, their products, their bookkeeping, their management training programs, their employee relations. It is high time they thought about modernizing their major financial practices, not the least important of which is their dividend policy. Chapter 20. Margin of safety as the central concept of investment. In the old legend, the wise men finally boiled down the history of mortal affairs into the single phrase, "This too will pass." Confronted with a like challenge to distill the secret of sound investment into 3 words, we venture the motto, margin of safety. This is the thread that runs through all the preceding discussion of investment policy, often explicitly, sometimes in a less direct fashion. Let us try now, briefly, to trace that idea in a connected argument. All experienced investors recognize that the margin of safety concept is essential to the choice of sound bonds and preferred stocks. For example, a railroad should have earned its total fixed charges better than 5 times before income tax, taking a period of years for its bonds to qualify as investment-grade issues. This past ability to earn in excess of interest requirements constitutes the margin of safety that is counted on to protect the investor against loss or discomfiture in the event of some future decline in net income. The margin above charges may be stated in other ways. It is said an Eastern monarch once charged his wise men to invent him a sentence, to be ever in view, and which should be true and appropriate in all times and situations. They presented him the words, "And this, too, shall pass away." How much it expresses! How chastening in the hour of pride! How consoling in the depths of affliction! And this, too, shall pass away. And yet let us hope it is not quite true. Abraham Lincoln, address to the Wisconsin State Agricultural Society, Milwaukee, September 30, 1859, in Abraham Lincoln, Speeches and Writings, 1859 to 1865, Library of America, 1985, Volume 2, p. 101. For example, in the percentage by which revenues or profits may decline before the balance after interest disappears, but the underlying idea remains the same. The bond investor does not expect future average earnings to work out the same as in the past. If he were sure of that, the margin demanded might be small. Nor does he rely to any controlling extent on his judgment as to whether future earnings will be materially better or poorer than in the past. If he did that, he would have to measure his margin in terms of a carefully projected income account, instead of emphasizing the margin shown in the past record. Here the function of the margin of safety is, in essence, that of rendering unnecessary an accurate estimate of the future. If the margin is a large one, then it is enough to assume that future earnings will not fall far below those of the past in order for an investor to feel sufficiently protected against the vicissitudes of time. The margin of safety for bonds may be calculated, alternatively, by comparing the total value of the enterprise with the amount of debt. A similar calculation may be made for a preferred stock issue. If the business owes $10 million and is fairly worth $30 million, there is room for a shrinkage of 2/3 in value, at least theoretically, before the bondholders will suffer loss. The amount of this extra value, or cushion, above the debt may be approximated by using the average market price of the junior stock issues over a period of years. Since average stock prices are generally related to average earning power, the margin of enterprise value over debt and the margin of earnings over charges will in most cases yield similar results. So much for the margin of safety concept as applied to fixed value investments. Can it be carried over into the field of common stocks? Yes, but with some necessary modifications. There are instances where a common stock may be considered sound because it enjoys a margin of safety as large as that of a good bond. This will occur, for example, when a company has outstanding only common stock that under depression conditions is selling for less than the amount of bonds that could safely be issued against its property and earning power. That was the position of a host of strongly financed industrial companies at the low price levels of 1932 to 33. In such instances the investor can obtain the margin of safety associated with the bond, plus all the chances of larger income and principal appreciation inherent in a common stock. The only thing he lacks is the legal power to insist on dividend payments or else, but this is a small drawback as compared with his advantages. Common stocks bought under such circumstances will supply an ideal, though infrequent, combination of safety and profit opportunity. As a quite recent example of this condition, let us mention once more National Presto Industries stock, which sold for a total enterprise value of $43 million in 1972. With its $16 millions of recent earnings before taxes, the company could easily have supported this amount of bonds. In the ordinary common stock, bought for investment under normal conditions, the margin of safety lies in an expected earning power considerably above the going rate for bonds. In former editions we elucidated this point with the following figures. Assume in a typical case that the earning power is 9% on the price and that the bond rate is 4%, then the stock buyer will have an average annual margin of 5% accruing in his favor. Some of the excess is paid to him in the dividend rate. Even though spent by him, it enters into his overall investment result. The undistributed balance is reinvested in the business for his account. In many cases such reinvested earnings fail to add commensurately to the earning power and value of his stock. That is why the market has a stubborn habit of valuing earnings dispersed in dividends more generously than the portion retained in the business. But, if the picture is viewed as a whole, there is a reasonably close connection between the growth of corporate surpluses through reinvested earnings and the growth of corporate values. Over a 10-year period, the typical excess of stock earning power over bond interest may aggregate 50% of the price paid. This figure is sufficient to provide a very real margin of safety, which, under favorable conditions, will prevent or minimize a loss. If such a margin is present in each of a diversified list of 20 or more stocks, the probability of a favorable result under fairly normal conditions becomes very large. That is why the policy of investing in representative common stocks does not require high qualities of insight and foresight to work out successfully. If the purchases are made at the average level of the market over a span of years, the prices paid should carry with them assurance of an adequate margin of safety. The danger to investors lies in concentrating their purchases in the upper levels of the market, or in buying non-representative common stocks that carry more than average risk of diminished earning power. As we see it, the whole problem of common stock investment under 1972 conditions lies in the fact that in a typical case the earning power is now much less than 9% on the price paid. Let us assume that by concentrating somewhat on the low multiplier issues among the large companies, a defensive investor may now acquire equities at 12 times recent earnings. That is, with an earnings return of 8.33% on cost, he may obtain a dividend yield of about 4%, and he will have 4.33% of his cost reinvested in the business for his account. On this basis, the excess of stock earning power over bond interest over a 10-year basis would still be too small to constitute an adequate margin of safety. For that reason we feel that there are real risks now even in a diversified list of sound common stocks. The risks may be fully offset by the profit possibilities of the list, and indeed the investor may have no choice but to incur them, for otherwise he may run an even greater risk of holding only fixed claims payable in steadily depreciating dollars. Nonetheless, the investor would do well to recognize, and to accept as philosophically as he can, that the old package of good profit possibilities combined with small ultimate risk is no longer available to him. However, the risk of paying too high a price for good quality stocks, while a real one, is not the chief hazard confronting the average buyer of securities. Observation over many years has taught us that the chief losses to investors come from the purchase of low-quality securities at times of favorable business conditions. The purchasers view the current good earnings as equivalent to earning power and assume that